All right, let's dive right in. Today, we're going to break down a systematic approach to the stock market. You see, the goal here isn't about guesswork or hoping to get lucky. It's about building a solid, durable process. We're going to walk through a 5-part framework that's really designed to align your decisions with the market's most powerful forces, giving you a clear path through all the noise. At its core, successful investing is really just a game of probability. The whole point isn't to be right on every single trade. That's just an impossible standard. Instead, the real game is about consistently putting yourself in situations where the odds are stacked in your favor. That way, over the long run, your wins are just naturally going to outweigh your losses. But here's the thing, and this is the central challenge that trips up so many traders. Those big, clean, easy-to-read trends, they're actually pretty rare. The vast majority of the time, the market is just moving sideways in a choppy, volatile range. And that's a really frustrating environment where breakouts fail, pullbacks reverse, and there's just no clear direction to get any real traction. So, that's the big question, isn't it? If these strong trends are the exception and not the rule, how in the world do you build a strategy that can navigate these tricky conditions and still be ready to pounce when a real opportunity finally shows up? Well, the answer lies in a structured, top-down approach that filters the market systematically, from the big picture down to the specifics. Okay, so the very first piece of the puzzle, the foundation for everything else, is simply identifying the direction of the overall market. That old saying, the trend is your friend, it's not just a cliché, it's a strategic imperative. The biggest, most sustainable gains are almost always made when you're moving with the primary market trend, not trying to fight against it. And this analogy just perfectly sums it up. When you trade with the trend, it's like you're sailing with a strong wind at your back. Everything just gets easier. The moves happen faster, they last longer, and you make progress with way less effort because the entire market is pushing you forward. So, what does a healthy uptrend actually look like on a chart? Well, it's pretty simple, really. Visually, the chart is moving clearly from the bottom left corner to the top right. And on a technical level, it's defined by a series of higher highs and higher lows. You can see it traced out right here. Each peak is higher than the last one, and each dip or valley is higher than the one before it. Now, what's really fascinating is why these trends stick around. It's not just random. There are a couple of powerful forces at play. The first is just simple momentum. An object in motion tends to stay in motion. But the second, more subtle reason is the lack of what's called overhead supply. Basically, this means that in a strong uptrend, almost everyone who owns the stock is sitting on a profit. They're not desperately looking to sell the minute it gets back to their break-even price. And that removes a huge source of selling pressure that can stop a rally dead in its tracks. All right, so once we've established that the overall market has our back, that we're in an uptrend, our focus starts to narrow. We don't want to just buy anything that's going up. We want to find the leading sectors. These are the specific areas of the market that are showing the most strength and attracting the most attention from the big players. This idea of a rising tide is just so powerful. When an entire sector has a natural tailwind, think about artificial intelligence right now, it creates an environment where it's so much easier for the companies within that group to succeed. All the best talent, the most investment capital, the media attention, it all flows in the same direction, lifting pretty much everyone in that space. You're basically positioning yourself in the strongest current in the river. It's also super important to understand what kind of trend you're looking at, because they're not all created equal. You can kind of group them into 3 main buckets here. First, you've got megatrends, like the internet or AI. These are long-term shifts that can literally reshape the economy for decades. Then you have boom and bust trends, like meme stocks, which are often just short-lived speculative bubbles. And third, there are cyclical trends, like oil and gas, which tend to move in waves based on the broader economic cycle. Our goal is to find those durable megatrends. So we've got the market trend, we've got the leading sector, now we're getting really specific. The third step in our funnel is to find the undisputed champion, the leader within that sector. In any industry, you'll find that capital and attention tend to flow disproportionately to that number one company, and that creates a really powerful feedback loop. Just think about it like sports for a second. Everyone knows who won the big championship last year, right? But can you name the team that came in second? Probably not, even though they were the second best team in the entire league. The winner gets all the headlines, the endorsements, the glory. And that same winner-take-all dynamic happens in the stock market. The leader attracts the best talent, the most investment, and the most loyal customers. A true market leader is defined by a pretty clear set of characteristics. They usually have a huge and growing slice of the market pie. Their revenue is growing much faster than their competitors. They have a brand that everyone recognizes, a culture of constant innovation, and they're run by a top-tier management team. These are the best-in-class companies we're looking for. Okay, now we've arrived at a really critical question. Even if you have the right company in the right sector in the right market, how do you know when to actually pull the trigger and buy? Timing is everything, not just to boost your potential profit, but maybe more importantly, to clearly define and manage your risk right from the very start. A proper entry point often comes after a stock has formed what's called a base. And a base is really just a period of consolidation. The stock moves sideways for a bit, it digests its previous gains, and it builds up energy for its next potential move higher. So buying as a stock breaks out of this base is a way of reacting to proven strength instead of trying to guess where the bottom is. Now, it's so important to have realistic expectations for what happens after you buy a breakout. Really, only three things can happen. One, the stock could just keep trending higher right away. Two, it could pull back and retest that breakout level before it moves up again. Or three, it could fail completely and trap all the early buyers. Just knowing these three possibilities ahead of time is the key to having a clear risk management plan in place before you even enter the trade. Let's move on to the fourth principle, which is all about the simple math that drives long-term profitability. This is where a lot of investors really get it wrong. You see, success isn't just about finding good stocks. It's about structuring your trades so that your winners can grow large enough to more than pay for all of your inevitable small losses. Now, this is where things get really interesting. Take a look at this table. It shows the relationship between how often you're right, your win rate, and how much you make when you are right. What you'll notice is that you don't actually have to be right most of the time to be very profitable. Look here. Even with a win rate as low as 30%, you can make really good money as long as your average winning trade is at least 3 times bigger than your average losing trade. So it all boils down to this one ratio, 3 to 1. This should be your target. For every $1 you're willing to risk on a trade, you should be aiming to make at least $3 in profit. This mathematical edge is what ensures that even a low win rate can still be highly profitable over time. It basically builds failure right into the system, which makes it incredibly resilient. And this brings us to the final and honestly probably the most important rule of them all, preserving your capital by cutting your losses quickly. This is the defensive side of trading. It's what keeps you in the game long enough for your winners to show up and for that positive math to start working in your favor. This quote is just so profoundly true, it's worth remembering. Catastrophic losses almost never happen overnight. They happen when someone lets a small, manageable loss grow into a huge, portfolio-damaging one, usually because of hope or ego or just refusing to admit they made a mistake. And if you ever needed proof of why this is so critical, just look at this chart. The math of trying to recover from a big loss is absolutely brutal. As you can see, a small 10% loss only requires an 11% gain to get back to even. But as that loss grows, the required gain grows exponentially. A 50% loss requires a 100% gain. You have to double your remaining money just to break even. That is a hole that is incredibly difficult to dig yourself out of. Think about it. Once you enter a trade, you have absolutely no control over whether it goes up or how high it goes. The market's going to do what the market's going to do. The one single thing that you, and only you, have absolute control over is your exit point. It's deciding how much you're willing to lose before you accept that your idea was wrong and you move to protect your capital. So we'll end with this one question to really reflect on. Is your process designed to satisfy an ego that needs to be right all the time? Or is it built on a foundation of probability and risk management that is designed above all else to be profitable over the long term? The difference between those two mindsets, well, that's what separates the amateurs from the pros.